Hi, we're back, right?
Yes.
Recording? Okay. We're back. And we're going to continue our conversation. I'd like to ask you a couple questions that are outlined in the textbook. I think what we're going to do here is we were discussing, we're going to stay away from the margin calls and et cetera. That's a somewhat, can be somewhat complex and certainly not required. They're going to mention it once here in chapter 2, and then they're never going to talk about these margin calls for the rest of the textbook. I think of we're purposely kind of bypassing that in chapter 2, and we're going to go right into more meaty subjects that are going to stay with us for the life of our investment, for our lifetime. It would be important to us as individuals, etc. And the first thing I want to talk about is some of these concepts with you, Professor Lipschitz, is market timing. Have you ever had any experience with market timing?
I actually have. When I was younger, I first started working. I was still in high school, and my father was a big investor. And so I was like, you know what? I can do this too. And so I tried to play the stocks, and I lost horribly on something you might remember, which was called Yahoo.
Yahoo! Wow.
They had a $120 billion market valuation back in like 1999, and by 2001, it had dropped to around $10 billion.
Yeah.
They lost a lot. But market timeliness is trying to spend the time in there just to see what the individual stocks are doing, right? It's trying to catch things as they're going down, but right before they go back up.
Right.
We're trying to see something right before it comes down after it's gone up for a while.
So what you're telling me is, in order to do this market timing, you almost have to be someone who's a fortune teller, who has a crystal ball and can project and see things that are, or at least try to anticipate on a high level of probability that these things are actually going to come to fruition.
Absolutely. And it's also just not the market timing itself, but the time you have to invest in this endeavor.
Exactly. Because I've seen it. I've seen people who are so addicted to watching the ticker tape in the market, they watch the computer all day. It is kind of like a gambling. It's kind of like going to the casino and playing the slots. And there are winners and losers. Now, I want to point out a classic, and I wish I could remember the time and date, but the Wall Street Journal did a comprehensive longitudinal study on investors and profiles of investors, and they looked at a series of people who were trying to time the market, playing and buying stocks and bonds every day in order to catch the ups and the downs, versus the person that just bought into the market and said, this is a solid company, I'm going to buy $50 a month into the market every month and just do this kind of a dollar cost averaging where I just put in it $100 a month, kind of like a 401k at work, where every paycheck you're putting in money into an investment portfolio, and did that for 20 or 30 years. The amazing thing was that the person who did not play the stock market and gamble every day solidly outperformed the person who was trying to time the market and trying to look for the deal and was every day addicted to the computer screen. And it wasn't just by a little, it was significant. The problem though with that scenario is we hear these incredible stories. Oh my gosh, I found this stock and I made a killing on it. That does happen. But over time is the great leveler. Over time, that advantage or those things get wiped out.
But nowadays, you're seeing a lot of timeliness come from computers.
Right.
Computers, computer algorithms, actuarial sciences, risk and return averages, and it's a growing field in mathematical computer sciences. The speed at which some of these trades can be made is astonishingly fast.
Right.
And they can make several trades within a second.
Yes. Milliseconds.
Milliseconds based upon these algorithms. And they might be making fractions of a cent But when you compound that with the number of times they're trading, with the amount of shares they're trading with, it comes out to be a lot of money. But
Exactly.
the average investor, as I found out, it is very, very difficult to do this.
So you don't have that algorithm, but the institutional investors do.
Yes.
The big brokerage houses do. Maybe foundations like I forget what Harvard has in its endowment. It's like $8 or $9 billion is sitting in its endowment. Then they have an institution. They're an institutional investor with a portfolio that large. They can actually impact and swing the whole market, and so they're trading with these sophisticated
and they have
things.
Dozens of investors working on just their endowment alone.
Oh yes,
Each one
whole
working on a
team.
specific sector and with specific knowledge in a specific area, whether it be natural resources or international or South America. And so they have specific knowledge of those areas.
But I would argue this, though. No one can predict the future, and therefore no one should try. In fact, if I could predict the future, just one day in the future, I would be probably the richest man in the world. Because I would know exactly what stocks to pick. I would know exactly what horses to pick. I would know what greyhounds to pick. I would know what lottery numbers to pick. I would know, if I had that kind of knowledge, I would capitalize immediately. I would own Tahiti. Not just go there, own it. But no one can do that. And maybe for a good reason. Maybe in God's kindness, He said you can't see the future, and no one can. So just be aware that market timing can be dangerous. It can be addicting. It can pan out from time to time. But my money, if I were a betting man, my money would be on picking portfolios and staying in them for the long term.
Now, one of the things that you can do, going back to Charles Schwab, is something they consider to be asset allocation or diversification. As we go back to that risk and investment profile, you can see that your investment profile strategy should change depending on your time horizon and your level of risk. The longer your time horizon, the higher your level of risk, you would have it very aggressive. And as the time horizon shortens, your level of risk decreases, your investment strategy has to change with it.
Exactly. So, if Professor Lipschutz is in 100% stocks, by the time he approaches 50, he might want to start moving out of stocks and moving more towards a bond portfolio. And bonds are typically, especially government bonds, as we learned, the risk-free was the Treasury bills, the T-bills, was the risk-free investment. If you recall, I believe it was 3.6% from the textbook.
Average return.
Average return. So that was the risk-free area. But how is the government going to default on its Treasury bond? I mean, if they wanted, they would never probably default because they can do two things. They can either raise your taxes to pay it off, or they can print money. So it is risk-free. And with that, you might say, okay, I need to start moving out of this risky position into a less risky position and actually buy some T-bills, buy some municipal bonds, buy different asset classes of bonds, because there's corporate bonds, there's government bonds, there's municipal bonds who have some really nice tax advantages too. And there's a whole series of bond categories that mitigate the risk, but yet still give you a return.
Now, one of the things you can do, if you're not familiar with it, some brokerage firms do have accounts which are target funds. They have a target date. Mm-hmm. And as the date approaches, they automatically adjust the allocation of those funds. One example on your board here is with Charles Schwab. Actually, let me try to increase the size a bit. And so Charles Schwab here, we're going to take a look at one of their target funds. So you can see how they're doing the funds, but something just to see here. Going back to what we were just looking at about risk versus return. Historical return was fairly low, but this was a very short time horizon fund, And as such, the historical return was also very low.
So the risk corresponds to the return. Now, this particular targeted fund, I believe you hit 2010.
Yeah.
Is that what you hit?
Mm-hmm.
Okay. He's very quick with this board. So he hit 2010. So 2010 has already passed. But there are still, so should be a very low risk portfolio at this point in time. And yet, because of the market, because of what's happened in the market, actually he's gotten a tremendous rate of return off that. If I'm looking correctly, it looks like 13.64%.
Mm-hmm. Now, if we come up here to say, well, we're going to look at the 2040.
So let's say you're going to retire in 2045. That's what this is telling me. This is the years 2040, because we're in 2018, right? And let's say you're going to retire in 2045. What would this portfolio, what does it look like as far as historical risk and historical return? Notice that we've shifted. So we can see that the historical return now has moved, this green light has moved all the way over here, and my risk, if you remember the 2010, this block was touched. Oh, you better not touch that screen. And it has moved significantly to the right, saying, "Hey, we're assuming more risk." The nice thing about these index funds, and they're basically tying themselves to an S&P 500 index or a Russell 2000 index or something along those lines. Even a Dow Jones Industrial Index. They're looking at these different index funds, and they're getting a large mix of stocks in these funds, and they're saying that, hey, look, if I were you and my time horizon was all the way out to 2045, you would probably want to take more risk. Okay, and that's what these things are trying to show us what's going on here.
Mm-hmm.
I do want to talk about some of the security selection and just discuss briefly. We've been throwing more terms around like bonds and stocks and mutual funds, and we haven't really gone into a lot of that. Thank you. Oh, goodness. I can't, for the students out there, that light is like a beam hitting their eyeballs, magnified through my magnifying lenses here. So let's just talk about what is a mutual fund. You describe for us a mutual fund.
Well, it comes back to the idea of what's a stock. Corporations issue stock, and an individual has the opportunity to buy individual stocks or multiple stocks of a corporation. And so you're holding what used to be a literal piece of paper.
Yep.
You owned a sheet of paper which said, I own a portion of this company. Mm-hmm. I owned a piece of Coca-Cola, or I owned a piece of Kodak.
Yeah, exactly.
But with the times changing and the opportunity to buy multiple different companies, so what it comes down to is somebody else is saying, I'm going to invest in all these different things for you. You can buy a piece of my mutual fund, and the money will go into these multiple diversified asset accounts or multiple different stocks.
So the individual stock was buying an individual company.
Mm-hmm.
Ford, GM, General Electric, General Dynamics. I love the Generals. And so you would actually own a piece of that company. Now, someone innovated. There was some financial innovation that occurred, and what people started saying, well, maybe what we ought to do is we ought to create a pool of funds that are of like mind. Say large companies that had been that are mature, and let's say these are large company value companies where you're no longer getting growth in the companies. The companies have matured; they're no longer growing; they're paying dividends. So we've created an asset class, haven't we?
Dividend yield funds.
Dividend yield funds. So we have large companies, large cap. Dividends, so they're valued. Large cap value fund. And I say I want General Dynamics, General Electric, General Motors. Those are three. And then I pick a series of other companies. Toyota, Mitsubishi, Boeing, Airbus. I picked these different companies that would fit into that category. Maybe not Airbus yet, but I picked different companies that would fit into that category of corporations. And I would then by buying a mutual fund, I'm buying each one of those companies. So maybe I could have 20, 30, 40, 50, even more companies that make up the fund. And what have I done? I've just diversified my risk. It's not just on one company anymore. I didn't throw all my eggs in one basket with one stock. I have now purchased stocks of like kind, but not the same, and I've spread that out. So someone came up with this innovative idea of pulling companies together and calling it a mutual fund.
So here's the idea, though. Previously, you as an individual would buy all those funds.
Yep.
Now, you're paying somebody else to do that for you.
Exactly.
You're paying for the ease of use. You're paying for the savings in time, but you're still paying for it, which you have to realize there is a cost associated with that mutual fund.
Yes, you have to pay the managers who manage the fund. Sometimes they'll have unperforming individual stocks within the fund that they want to replace.
Which is actually what brought about the creation of mutual funds.
Exactly.
It was a fee-generating service.
Exactly. But it took a lot of the guesswork out. You put it in the hands of a professional. And you got your risk was somewhat mitigated by the larger selection. It was spread over all these different companies. So it became very, very attractive. And it still is very attractive, quite frankly.
I think mutual funds are one of the largest areas of investments today.
Sure, 401ks.
Just because of their ease of access. Anybody can go out and purchase a mutual fund. It automatically diversifies their portfolio away from a single stock or single account.
Exactly. So you may have a mutual fund in the large cap value category. You may have a mutual fund in a large cap growth category where you have a company that is huge, like Google's still a growth stock. Apple's still a growth stock. They're not giving dividends yet. So you have different companies that are still growing and large. Then you have mid-cap value, mid-cap growth, mid-cap or small-cap value, small-cap growth. You have growth and value. You have large, small, mid. You may have international value, a large cap, international, mid-cap. So you have all these categories. And if you buy a mutual fund in each of these categories, you further are diversifying your portfolio. You're taking advantage of overseas companies. You're taking advantage of different size companies with different perspectives and different ways of investing those precious dollars that you earn, so that you have much more greater opportunity for growth and less of an opportunity for a downside. That's kind of the idea behind the mutual fund, and that's what we're talking about when we talk about asset allocations, at the beginning of asset allocations, diversification, etc.
So when you're looking at those mutual funds, some specific numbers to look at is the expense ratio.
Yeah.
How much is being allocated towards the expenses of that fund?
Exactly. And as you delve into this, it's not in this chapter, but it will be coming up. There are categories of mutual funds. There are A shares, B shares, and C shares, and it depends on how long you're going to hold the shares. Depends on what fees you're going to pay. Is there a front end load, meaning you pay a fee to get into the fund up front? Or is it a B share, which has a back end load, where when you leave the fund you have a fee? Or is it a C share, which says there are no fees because you have agreed that you're going to hold this puppy for a long time?
Which comes into the idea of liquidity. Liquid assets, right? Cash is very liquid. You can use cash now, you can save for later, you can transact it, you can change hands. Cash is the most liquid asset we have.
That's why it's called king.
It's the
Cash
king.
is king.
Now the problem is we look at other investments as to how liquid they are. How easily convertible to cash is it?
Yes, and that's the key, convertibility to cash. Now, you have a piece of property, you have your house. In this market, I bet your house would go like that. But let's say 5 years ago, if you were to put your house on the market and you needed cash right away and you need to sell your house to get cash, how long do you think it may have stayed on the market before you would have gotten one dime?
Well, we purchased our house a little bit over 5 years ago. I think it was around 6 or 7 years ago. And our house is actually on the market for 9 months.
9 months.
Before we purchased it. And we were able to negotiate the price down considerably because it was on the market for so long.
Exactly.
The realtor and the builder was losing money every month. That property was just sitting there because they're still paying their interest. They're still paying the taxes on that property. And so they were willing to negotiate the price.
Right. That's a supply and demand function. At that time, the real estate market was in the tank.
Mm-hmm.
And so there's an asset class, real estate. The real estate market was in a tank. It was a great buyer's market. You could buy real estate cheap. Now, this thing has changed now. But I guess my point is it was an illiquid asset because it took 9 months.
Mm-hmm.
Now I'm seeing properties because the market is heated up, which means people are again buying houses in droves. And I think in my neighborhood right now, a house lasts on the market only 4 days. The average house where I live is 4 days and it's sold, and they're selling. There's a price war, so people put it on the market, and people are getting a premium. So they're getting $30,000-$40,000 on top of asking price and the premium. Now I don't understand why the real estate market can't adjust to the market quickly enough, but apparently this is what we would call a seller's market, and it seems like sounds like real estate's very liquid.
So when you're investing, though, my investments do not have to be liquid. I am not withdrawing my funds any time in the near future.
Exactly.
And so I can have funds that are not considered to be liquid. However, as you get older and nearing retirement age, where you need to withdraw those funds, you need to start having more liquid assets to be able to withdraw those funds in case of emergency, in case of any medical expenses, in case of anything that arises.
Exactly. And by law, you find out this a little later, at 70 and a half, the federal government will force you to take money out of your retirement account. In fact, if you do not take it out, they will tax you at 50% of what you should have taken out. So you're forced into what we call required minimum distributions. And my mother's in this situation. So she has to take money out of her IRAs at this point. And so we have to have this money to be available and moving to cash constantly. And every month she gets a check from her investment portfolio that she could take the check and put it back in the stock market in a different type of a investment vehicle. She could pop it right back in, but it can't be in a retirement account designated by the IRS for retirement. But notice that it has to be this cash flow every month. A check comes to the house. In her case, I think every month it comes to her and it goes through a bank and back into the investment portfolio or back through the broker into a different way. In any event, this idea of being in a more liquid investment structure becomes important. How fast can you sell and get cash out of your market? Let's say you had just a regular brokerage account, not a retirement account. And if you sold a mutual fund, do you have an idea how long it takes you to get out of that mutual fund or stock?
For me and mine, because I have Charles Schwab and other investment brokers, it's usually about 3 to 5 days.
Exactly. It's fairly liquid.
It's fairly liquid, but it's still, I need to plan 3 to 5 days in advance when we're doing any major transactions.
Exactly.
Paying a tuition bill, anything like that, because I know I have these bills coming up. I have to plan ahead because it takes time. I can go online, I can request a transaction, then the transaction has to be processed the next business day, at which time there's funds that are transferred, and the funds that get transferred, then they have to be authorized, and they have to be authorized to me, and then transferred to me, right. And then it has to be approved by my bank to actually get the funds out.
And then a check has to be cut in the process, and whether it's direct deposit or whatever. It has been streamlined significantly because of technological advances. In the old days, if I were to sell a mutual fund, I would call my broker on a landline, not a cell phone, and say, "Can you sell this puppy?" And he would say yes, and in 7 to 10 days it would be sold, and probably another week later I would get a check. So we've got 14, 15, 16, maybe 20 days could be total, because these were business days, not weekends didn't count. So this is a long time to get a check, and so it wasn't that liquid. Or if I went to my checking account or my savings account, I pull out cash or I write a check, it's immediately available to me. That's what we're talking about when we talk about liquidity. We touched upon a number of things here. We talked about what is kind of a mutual fund, an individual stock. We're going to get deeper into these subjects as the course moves forward. But we're just trying to familiarize some of the students right now and touch upon some of the larger subject matters. I think this is a wrap then for Chapter 2.
Yep.
And we'll see you guys the next week in Week 3 and explore what's happening there.
Have a good week.
Yep. Posted.